Welcome back to the channel, guys. There's been a lot of kind of talk in the community around these income products in particular versus growth, and I just wanted to do another video on this. I did do a video previously in the past that kind of did explore a lot of these things, but probably went into a lot of depth. And so I want to do another one that's maybe a little bit more generic, a little bit more high level to answer some of those questions. But I will pin up the other video or link the video in some way to this one. To those of you who have not seen that video, after you watch this one, I recommend you go watch that one as well. But the ultimate retirement question, right? Are you better off going for growth, chase that biggest gain, and then sell pieces of it later? Or are you going for the income, build a cash flow machine that pays you forever? It's the classic investment dilemma. The right answer is a lot more nuanced and complex, changing with the market and your personal goals. The idea of this guide is to break down the data so you can decide on the smartest path for your money. Right now, nothing in this video is obviously investment advice, but hopefully it will give you some greater kind of insight. The key outcome, which we talk about a lot, which is the total return approach, right? So this philosophy judges success by the overall return of your portfolio, whether that be the combined total of a capital appreciation, growth, and all income received in the forms of dividends or interest. It treats a pound from a dividend as identical to a pound from selling a share. You create your paycheck flexibly, either by spending the income generated or selling assets, whichever is the most efficient at that time. The income-focused approach is the strategy prioritizes building a portfolio where the natural cash flow from dividends, interest, and options premium is sufficient to meet spending needs. So the primary goal is to generate a predictable paycheck without having to sell the underlying assets, providing some psychological comfort and discipline. So when we look at how do you get paid, path one is still the total return. Focus on growth assets like the S&P, where you need cash, you sell portions of your holdings and realize capital gains. There's the income focus path. Your paycheck arrives automatically from dividends, interest from bonds, and premiums collected from selling call options. And then there's path three, which is the hybrid approach, a kind of blended model. You hold growth assets, but also generate income from a sleeve of dividend stocks and option strategies to supplement cash needs. And I sit in the third camp personally. And again, that's just my own opinion. I think that there is a benefit to having this hybrid approach. And I'm going to go into that now. So this is just the outcomes of real world index comparison. So this chart tracks a 100K investment dollars in this particular scenario from sort of Jan 2000 to December 2023. And it shows how each strategy navigates real market events. So I've highlighted three kind of events that have occurred during that time, and I've tried to keep it over a decent time frame, but more relevant time frame for most of the viewers, which is obviously the dot-com bubble, the financial crisis, and the other one that happened in 2020. Now, all this data is taken from the Dow Jones indexes, the CBO, and as I said, the periods from about 2000 to 2003. And as we can see, there's three crucial lines, right? There's the total return of the S&P 500. There's that 50-50 blend, so that's path three. And then there is the path two, which is that income approach. And what we'll see here is that during times where, we are seeing those downturns, we can see the various trends happening over time where one will eventually take over the other, depending on what's happening in the market conditions. And we always think of total returns as being the best approach, and that is the focus, right? And we'll see all of these different trends and the dips as they occur. Now, that doesn't mean one strategy is necessarily overall better than the other. It just means they all have their own approach and their own benefits. But we'll see the hybrid kind of sits nicely in the middle of all of these. And that's why I think that although it's never going to beat having pure growth, it's going to do better than just having pure income. And so it gives me that balanced mix. And I'll talk about why, for me, that balanced mix is quite important as well. And it comes down to when we look at the different market conditions. So obviously, the highest return is still going to be most of the time just riding out the S&P 500 volatility. We've then got the hybrid approach, which has obviously got that balance of growth and still capturing some upside while trying to mitigate some of the downturn. And then you've got the income, which is trying to make sure that your beta is lower than the general market, but you're still capped on that upside typically. So if we were to look at this in market conditions, right? So no strategy is going to win all the time. And here's how we typically perform under different kind of economic weather conditions. So if we look at a bull market, which is where the market's rallying upwards, total return, uncapped growth potential, allows it to capture the full power of the rising market, and income strategies will always lag as their options are typically capped when we talk about covered calls, certainly. In a bear market, we typically see income focused funds will typically beat out. The premium income from the options act as a kind of cushion that significantly reduces losses compared to a pure growth strategy, which feels the full impact of a decline. And then in a sideways market, we'll typically have income focus that while growth stagnates, the income strategy continues to generate that cash from the options premium, creating a positive return in a flat market. And this is often referred to as that theta decay. And I've done plenty of videos on the terminologies of the Greeks. So I recommend, again, if you're not familiar with the Greeks, to go and watch that video as well. Now, on the surface, it looks like, why wouldn't you buy income products alone? It's doing well in 2 out of the 3 market conditions. The challenge you've got to realize is that markets traditionally over a long period of time have always gone up, okay? And those things are not linear. They've gone up in quite big chunks. Sometimes it'll go up by 20%. Whereas in a bear market and a sideways market, you're not going to get as much income as that to offset the amount of growth that you see in the markets. And that's why we often say there isn't really a free lunch out there in terms of the strategy. So although at a very high level, it looks like bear market, sideways markets, income is winning out of 2 of the 3 user cases, but the reality is the amount of growth that you do get in the bull market is much more than the income. So if we were to look at this from a navigating the risk side and why I feel like the hybrid approach is a good one. When we look at total return risk, the sequence of returns, obviously the nightmare scenario is a market crash happens right when you need to start selling assets. And that can have a real massive crippling effect on a portfolio's ability to recover. And whether you have a bad start but a good end, or a good start and a bad end, is really important, particularly when we talk about time horizons and retirement. And similarly with an income strategy risk, the assignment opportunity costs. Options income isn't free. You're paid to take on an obligation, which comes with its own distinct risks for both calls and puts. From a covered call perspective, if the stock price soars, your shares are called away. You miss out on all the gains above your strike price, or the opportunity cost, as it's often referred to. The cash secure put risk is stock price plummets, you get put the shares and you're forced to buy a stock at a higher strike price, even if it continues to fall, which is often referred to as the assignment risk. So you're potentially owning a stock for less than what it's now worth. So unless it starts to recover, you're sitting on a loss. From a bottom line and key takeaways perspective, the end goal is still to maximize wealth, right? And endure the volatility in the process. So total returns historically has built the most wealth, but it's a turbulent ride, right? Success demands the resilience to withstand deep market drops without panic selling, and especially near retirement. And we've seen that a lot, where people see the market drop 10%, 20%, 30%, and they start selling. Obviously, this creates opportunity on the other side, but people obviously sell at the wrong times, and we all know why that happens from a psychological standpoint. But obviously, that really does erode wealth over time. Obviously, trading peak gains for a kind of a smoother ride. So income strategies act almost like a little bit of a shield, offering that stability and cash flow during those market storms. So this protection has a cost. You sacrifice growth if there was a big rebound or there was a bull market. And also, like being forced to buy and selling a falling stock when it comes to puts, again, there's a trade-off there. Is it the perfect recipe on its own? No. Obviously, adapting to that economic weather. So there's no single strategy that wins forever. The best approach changes depending on whether it's a bull market, which favors total returns, and a bear and sideways, which typically rewards income strategies. Not always, but majority of the time. So for me, the smart path is a hybrid one, in my opinion. So for me, the most resilient solution is a dynamic hybrid approach, blending a core of growth assets with an adaptable income sleeve that kind of lets you capture market gains when they happen and create your own cash flow when they don't. Now, obviously, there's still some nuances, which, as I said, I explore in the other video, which is around the balance of how much do you take in terms of growth and how much you take in terms of income within that balance. But again, as I said, I've covered that in the other video. So I'd recommend, if you haven't seen that one, to go and watch that one as well. But there you go, guys. That's my opinion on this, that these products, these income products, do have a value in a portfolio. But again, it's thinking about what is the balance and the market conditions, and also your time horizon as well. That's so important. What we've also got to realize here is that, compounding doesn't happen overnight. Charlie Munger was famous for saying that the first 100K was the hardest for a reason, because you're putting a lot of the capital in up front and you're not seeing the compounding effect take over. And I think there's a lot of misleading things on YouTube around that, where people say, oh, you go from 0 to 100K. But the reality is the compounding really doesn't take over by itself. And what I mean by that is you've got to put a lot of the upfront effort in and sacrifice a lot of things up front. And then eventually the compounding makes it easier and it starts to take over. In effect, the amount that you're putting in is much less than what you're getting from the compounding effect. So there you go, guys. Hopefully this was a useful video and answers some of the questions around stuff that's happening in the community. Thanks to the 100% Club for staying till the end, and I will catch you in the next one.